Have you ever looked at the stock market hitting all-time highs, and then you look at your own bank account and wonder if you're living on a totally different planet? Yeah, you're not alone. And it turns out there's a really good reason for that feeling. So let's get into it. Let's unpack this huge disconnect between Wall Street and Main Street. Okay, so here's the puzzle right up front. On one side of the coin, you've got the S&P 500 and the NASDAQ posting these incredible gains. Looks great, right? But on the other side, the reality for millions of people is a serious affordability crisis and consumer stress that's hitting historic highs. How can both of these things be true at the exact same time? Seriously, what's going on? How can the market be throwing this huge party while so many people are just feeling squeezed by the high cost of, everything? Housing, food, insurance? That is the exact question we're going to answer right now. All right, so to really wrap our heads around this, we need to start with what some people are calling the market paradox. And the best way to picture it is with a concept you've probably heard thrown around a lot lately, the K-shaped economy. So what the heck is a K-shaped economy? Well, it's actually a pretty simple idea. Just picture the letter K. You've got that top line shooting up and to the right, and then you've got that bottom line heading down and to the right. That's our economy. One part is doing great, soaring upwards, while another part is just falling behind. It's one country, but two completely different financial worlds. And you can see this playing out everywhere. I mean, just think about it. The tech world, absolutely booming. But then you look at industries like tourism and local restaurants, it's been a much tougher ride. Or how about this? High earners are seeing their stock portfolios just balloon in value, while so many other folks are just worried about the price of groceries and rent. It's really a tale of two economies happening side by side. And this brings us to the first huge piece of the puzzle. You have to understand, when we're talking about today's stock market, tech isn't just another slice of the pie. In a lot of ways, tech is the entire pie. The scale of this is just wild. When you take the pure tech stocks and then you add in what we call tech-adjacent giants, your Googles, your Metas, your Amazons, you're looking at about half, 50% of the entire S&P 500. That's an absolutely insane concentration of power in just one part of the market. And this chart really drives the point home. You see that giant bar for tech and communications? 46%. Now look for the next biggest one, financials. Way, way down there at just 13%. This isn't even a race anymore. It's just complete dominance. The whole market has become incredibly lopsided. So how did it get this way? Well, it created this powerful self-feeding loop. Stick with me here. It starts with tech stocks getting massive. So massive that the professional fund managers, the people paid to pick stocks, they can't buy enough of them without breaking their own risk rules. So they start to underperform the overall market. And investors, they notice. So they pull their money and put it into simple passive index funds. And what do those index funds do? They just automatically buy more of the biggest stocks, which are, you got it, the big tech companies. The big get bigger and the cycle just keeps going. So if tech is taking up all the oxygen in the room, what's getting pushed to the side? Well, it's us, the consumer. And this is the second really critical point we have to get. Your spending, my spending, it just doesn't move the needle for the stock market like it used to. I mean, we've all heard this our whole lives, right? The consumer is the engine of the U.S. economy. 70% of our entire GDP is driven by people like you and me buying stuff. It's the absolute backbone of the real economy. But then you look at the stock market. All those sectors that actually depend on our daily spending, think retail, travel, cars, all of them combined now only make up about 25% of the S&P 500. Let that sink in for a second. The biggest part of the real economy is now a pretty small part of the stock market. That is a massive disconnect. And this really gets to the heart of it. The investor Steve Eisman summed it up perfectly. He said, the stock market is now divorced from everyday life. The market can keep climbing higher and higher because its biggest players are driven by massive corporate spending on things like AI, not by whether you can afford your rent or your health insurance. But there's one more hidden force that's taking all of these trends and just putting them on steroids. It's the fact that a huge part of the market is basically flying on autopilot now. Get this. A full 60% of all money flowing into the stock market now goes into passive index funds. These are the funds that don't have a human picking stocks. They just automatically buy everything in an index, like the S&P 500. That means the majority of investing today is automated. And here's what that really means. The whole system is basically set up so the biggest stocks automatically get the most money. It's got nothing to do with whether a company is a good value or has amazing new ideas. It's just about size. It's the big gets bigger effect in its purest form. So, okay, we've got a top-heavy, tech-dominated market, and it's all being amplified by automated investing. Now, this is great on the way up, right? It's a rocket ship. But what about on the way down? This is where you start to see the hidden fragility in the whole system. Which brings us to the really critical question. This entire market rally is basically built on the foundation of massive AI spending. So what happens if that spending slows down even a little bit? Or what if a real recession finally shows up? Well, according to Eisman, those same forces that created this relentless rise will just go into reverse. When the selling starts, all those automated index funds will be forced to sell mechanically. There won't be enough active buyers to step in and stop the slide. His prediction for what that kind of correction looks like? Fast and very ugly. So let's bring it all together. What have we learned? First, and most importantly, the stock market is just not the real economy anymore. They're two different things. Second, tech's incredible dominance, poured into overdrive by automated investing, has completely reshaped the game. This means that AI spending is the single most important driver you have to watch. And the final critical takeaway is this. Because of this new structure, when the AI boom eventually falters, the same forces that shot the market into the stratosphere will accelerate its fall. And it won't be a gentle landing. So the real question isn't whether the market reflects our reality, it's what happens when it's finally forced to.